A very good evening to all the participants of this webinar. Today, our topic of discussion in this webinar is capital and revenue receipts. And this is the part 2 of our webinar on capital and revenue as part of the bookkeeping and account series. So we begin with capital receipts and revenue receipts. In the earlier webinar, we had done capital expenditure and revenue expenditure. And now we'll be covering capital receipts and revenue receipts. Friends, just as we have to be very clear before we make an entry in the books of accounts, whether an expenditure is capital in nature or is it revenue in nature, we have to make a decision whether a receipt is capital in nature or revenue in nature. Because unless we take that decision, we will not be able to make an appropriate entry in the books of accounts. So therefore, we need to distinguish the capital receipts and revenue receipts very, very clearly. But as we have said that the dividing line is thin and the work is not easy to do. Now those receipts which are obtained in the course of normal business activities are revenue receipts. For example, those receipts which are coming from the sale of goods or the sale of services or from interest income. These are all part of normal business activities from which receipts are coming, and we label them as revenue receipts. On the other hand, receipts which are not revenue in nature will be called capital receipts. Like when we sell any fixed asset or we sell off any investment, then the receipt that we get is a capital receipt. Similarly, when we take secured or unsecured loans, or when owner contributes his own capital to the books of accounts of the business, that contribution of the owner is also capital in nature. Revenue and capital receipts are recognized on accrual basis, by which we mean that as soon as the right of receipt is established, we recognize it. It has got nothing to do with actual cash receipts. Actual receipts may come before or even after the accrual. And the revenue receipts are credited to the profit and loss account. On the other hand, capital receipts are not directly credited to profit and loss account. For example, when we sell a fixed asset for 92,000 rupees, the capital receipt, which is 92,000 rupees, is not going to be credited to profit and loss account. The profit or the loss on the sale of fixed asset is calculated, and that profit or loss will be credited to the profit and loss account. And this profit or loss will be calculated like this, that out of the sale proceeds, if the cost of the fixed asset was 90,000, then we reduce the cost from the sale proceeds, and the profit is 92,000 minus 90,000, and that amount would go into the profit and loss account. Now let's go to the illustration where we'll find some examples. Now, Good Pictures Limited constructs a cinema house and it incurs the following expenditure during the first year ending 31st March 2016. Number one, second-hand furniture worth 9,000 was purchased. Now this furniture was repainted and the cost of the repainting was 1,000 rupees. This furniture was installed by own workmen who were paid the wages of 200 rupees. Now here what is being done is a capital purchase is being made. The second-hand furniture is a capital amount, capital item, which is being purchased. The repainting expenditure is also capital in nature, and the furniture which was installed by workmen, they got wages. So wages were also going towards the installation of the furniture. So therefore, installation cost is part of the furniture cost. It will add to the cost of the furniture. So 9,000 plus 1,000 is the total cost of the furniture, and therefore thereafter wages are also being spent on installing of the furniture, and therefore that is also becoming part of the cost of the furniture. So therefore this all is capital expenditure. The total cost of the furniture is 10,200, 9,000 plus 1,000 plus 200. And therefore all these three amounts are being capitalized here. Because without this expenditure, the furniture would not be used by the business, could not be used by the business. So these items of expenditure are making the furniture fit to be used by the business. If 1,000 and rupees 200 have been respectively debited to the repairs account and wages account, these accounts will be credited to the furniture account. So when we are making this expenditure, basically what we are doing is that we are crediting the bank account or the cash account and debiting the furniture account. Now, number 2 is expenses in connection with obtaining a license for running the cinema worth 20,000 rupees. Expenditure has been made for obtaining this license for running the cinema. Obviously, it's a capital expenditure because only with the help of this license the cinema business can be run, and therefore it is going to cause a long-term benefit to the business. During the course of the year, cinema company was fined 1,000 rupees because it contravened certain rules, and a renewal fee of 2,000 for next year was also paid. Now what is happening here is the license fee is the capitalized amount, has to be capitalized, but the fine which is being paid, which is of 1,000 rupees, that is being paid only to maintain the capital asset, not to make an improvement in it, and therefore this fine will be revenue in nature. Thereafter, the renewal fee that has been paid for next year will also be a renewal revenue expenditure because this is being paid to just keep in place or maintain the cinema business. But since it is for next year, it will be taken into a prepaid expense account because it has not been incurred and it is an advance payment, and therefore it is a prepaid expense. The third question is fire insurance 1,000 was paid on 1st of October 2015 for 1 year. Now the insurance premium of 1,000 rupees that has been paid for 1 year, it is suddenly this amount that has been paid of 1,000 rupees, it is paid for on 1st of October 2015 and it is paid for 1 year, and therefore since it is paid on 1st of October, 6 months have already expired. So only half of this amount is a prepaid expenditure and rest is not a prepaid expenditure. because half of this amount is an incurred expenditure and half is a prepaid expenditure, that which belongs to the next year. But it is a revenue item because the insurance premium is paid to maintain the business. So it is a revenue item. So half the amount of 1000 is a revenue expenditure, that is 500 rupees, the revenue expenditure for the current year. And the rest of the amount 500 is not for this year. It pertains to the next year and therefore it is a prepaid expenditure. And as you know, the prepaid expenditure will go to the asset side of the balance sheet. And in that sense, because it is not accrued, and as we said that capital and revenue expenditure and receipt items need to be accrued to be recognized. And that is an important item to keep in mind. Therefore, out of this 1000 rupees, 500 will be debited as a revenue expenditure and 500 will go to the prepaid expense account. How it will go to the prepaid expense account? The bank account will be credited and prepaid expense account will be debited to the extent of 500 rupees. Now number 3, or rather number 4, temporary huts were constructed costing rupees 1200. Now these huts were necessary for the construction of the cinema, and as we have discussed earlier, this is a capital expenditure. Since these huts were demolished later on when the cinema was ready, but that doesn't mean anything. That does not detract from treating it as a capital expenditure. Since the temporary huts were necessary for the construction, their cost would be added to the cost of the cinema hall, even if they are demolished. And this cost of 1200 rupees will be capitalized. Now we go to illustration 4. We have 3 more examples here. Overhauling expenses of 25,000 rupees were paid for the engine of a motor car to get better fuel efficiency out of the motor car. So these overhauling expenses are incurred for the engine of a motor car. These expenses will reduce the running cost in future, so they will lead to a future benefit, and therefore that we are going to get enduring benefit out of it. Since we are going to get enduring benefit out of it, therefore this expenditure on overhauling leading to better fuel efficiency will be capitalized. Number 1, this expenditure is not just for 1 year, it is going to bring profits, benefits in future years also by increasing the fuel efficiency and thereby reducing the expenditure. So therefore, in a sense, it is a long-term benefit that is being acquired by making this expenditure. That primarily makes it a capital expenditure because an enduring benefit is emerging out of it or inuring out of it. Now second is inaugural expenses of 25 lakhs incurred on opening of a new manufacturing unit in an existing business. The business is an existing business, and in that a new unit is being set up, is being opened. Now when you open a new unit in an existing setup, more customers will come in future. Now this expenditure that is being made on the inauguration expenses, it could help to go for more customers, but that by itself doesn't mean that there is going to be an enduring benefit from this. Enduring benefit is not assured here. Inauguration has been made of a new unit. The expenditure on the new unit is definitely capital in nature. But that doesn't mean that inauguration expenses made on new unit will also be a capital expenditure, because inauguration expenses is part of the normal business activity of any business, and it is not going to lead to a direct enduring benefit in the future years. If we inaugurate in this year, doesn't mean the next year we are going to get a benefit out of it. At the most, we may get some more customers in this year, but no enduring benefit in the coming years out of this. So therefore, the enduring benefit principle is a very important principle to decide whether certain expenditure is capital expenditure or revenue expenditure in nature. The third example is the compensation of 2.5 crore rupees which is paid to workers. Now these workers have opted for voluntary retirement. The workers have been paid voluntary retirement benefit. Now the magnitude of the amount of expenditure is very significant, because a lot of a big amount is being expended here, is being spent here on the workers, because they are going for voluntary retirement. But here what is happening is that we are reducing our cost straight away. We are reducing our cost straight away. So we are making an expenditure which is leading to immediate benefit, not a future benefit. An immediate benefit is resulting because cost is being reduced straight away. If the cost is being reduced straight away, then the expenditure on the workers on voluntary retirement benefits is in the nature of the revenue expenditure. But of course, the amount is significant. So if the amount is significant, what can be done is that it can be deferred over future years. Now, when an expenditure is deferred over future years, what we do is that we capitalize it in the first year, and we treat it as revenue expenditure over a period of time, let's say 4 years or 5 years or 6 years. So part of it which is being debited to the profit and loss account in this year will be treated as the revenue expenditure. The remaining part will be treated as a capital expenditure, and it will be deferred over future years. So one principle that we have understood earlier also, that an expenditure that is significant amount in size can be deferred, in the sense that it can be treated as a capital expenditure and can be deferred and treated or amortized over a period of time, as is being done out here. So the principle that is being followed here is an expenditure which is of a large amount in nature is being treated as a capital expenditure to a greater extent, let's say 80% and or 90%. 10% of it is treated as revenue expenditure for that year, and the remaining part in the future years. So the size of an expenditure can also sometimes make an expenditure a capital expenditure, though we cannot be sure that any future enduring benefit will come from that. Straight away the cost is being reduced, because we are giving up certain workers permanently. They are going for voluntary retirement. Those workers will not have to be paid any salary, and therefore the recurring cost is going to decrease over a period of time. But at the same time, the amount that is being paid on voluntary retirement is taking into account that future benefits of number of years are being allowed in one particular year itself for the workers. And therefore, whatever benefit is being given, that doesn't belong to only 1 year, it belongs to many years. And it is a large amount, so therefore we are treating it as capital. Even when enduring benefit is not assured, the huge amount of expenditure that is being made here to reduce the cost is partly revenue and partly capital in nature, depending upon how much amortization is being made. or how much allocation is being made in form of revenue expenditure for this year and for every future year. Now we come to illustration 5. Rupees 10,000 was spent as traveling expenditure of the director. Director went on a trip abroad for purchasing the capital assets. And 10,000 rupees was spent on traveling of the directors who went on the trip abroad for purchase of capital assets. Now, this expenditure is straight away, it is directly correlated with the purchase of capital assets, and therefore it can be treated as a capital expenditure. Number 2 is the amount which is received from the trade receivables during the year. Trade receivables are the receivables which are accruing every year, and therefore whatever amount is received out of the trade receivables in a particular year is a normal business expenditure. It is a receipt coming from the normal business activities, as we have understood earlier also. And since it is coming from the normal business activities, it is revenue receipt in nature. I would like to point out to you in the first paragraph itself, when we studied capital and revenue receipts, in the first line here it is stated clearly, receipts which are obtained in the course of the normal business activities are the revenue receipts, and those receipts which are not revenue are capital. So here as part of 2, we can say the amount which is received from the trade receivables, being part of the normal business activities, is a revenue receipt in nature. Amount spent on demolition of building, number 3 of illustration 5. Amount which is spent on the demolition of a building to construct a bigger building. Now, when a bigger building is to be constructed, the old building has to be demolished. So whatever expenditure is being made to demolish the older building, it is also in fact going towards the construction of a bigger building basically on the same site, and therefore the amount on demolition will also be a capital expenditure in nature. Then we come to part 4. Insurance claim which was received on account of a machinery damaged by fire. Machinery is damaged by fire. Machinery is a capital amount, a capital asset. It is damaged by fire. And to restore that machinery, or in respect of the capital asset which was damaged by fire, an insurance claim is received. So therefore it is relatable to the capital asset, and therefore it is an insurance claim. Because it is the insurance claim will help to restore the damaged machinery. A machinery whose value is now maybe 0 or 10 can be, the value has to be raised by using the insurance claim money. And therefore the amount which is being received as insurance claim, it is being received to restore the property or the asset of which the value has been reduced to nothing almost by fire. And therefore what is happening is almost a new asset which is being created out of the ashes, and therefore this amount of insurance claim is a capital receipt because it is relatable to the capital asset. Now we go to illustration 6. Messrs. ABC and Company, they are running a restaurant. What they do is that they renovate some of the old cabins in the restaurant. Restaurant has got a number of cabins where people sit and eat. They are renovating. Renovating means basically making it absolutely new. Now, because of this renovation, some space was made free and number of cabins was increased from 10 to 30 as part of the renovation process. The total expenditure which was incurred was 20,000 rupees. Now, what is happening here, when we look at it carefully, number of cabins are being increased. So by increasing these number of cabins, the future revenue generating potential or the future revenue generating capability of the business will go up. And therefore, an enduring benefit is most likely to occur here. Or rather, the expenditure is being made directly to have an enduring benefit from it. And therefore, the revenue expenditure being made here is capital expenditure in nature. We go to the second example. Messrs. New Delhi Financing Company sold certain goods on installment payment basis. Five customers did not pay installments. So to recover the outstanding installments, the firm has spent 10,000 rupees on legal expenditure. Now what happens is that in course of a business where you are giving financing for, you're doing financing for vehicles or any other thing, it is very likely that some of the customers will not be able to pay the outstanding installments. And therefore, you will have to make some expenditure to recover the expenditure or recover the loan that you have given. So that is a normal business activity. It is a normal recurring expenditure of the business. It has got nothing to do with the future revenue generating potential or the future revenue generating capacity of the business. And it is just a normal recurring, repeating, expenditure of the business that every now and then some of the outstanding installments will fail to be recovered, and therefore you'll have to spend on legal expenses to fight the cases, or by way of by taking recourse to legal action to recover the amount. So this is not capital but revenue expenditure in nature. Now once again clarifying another example that we had done in the earlier webinar before I go to the third one here. As we had seen earlier also in the morning, that an amount of 10,000 rupees was paid to the MTNL to install a telephone. Now, when this amount of rupees 10,000 was paid to MTNL to install the telephone, the MTNL had told us that in the future bills, they will adjust this amount. So the amount which is paid in advance, which is adjustable later on, it is just like an advance being paid or a prepaid expenditure also, if you may take it like that. And you may even take it as a cost of the telephone. So when you pay the 10,000 rupees, you credit the bank account and you debit either the telephone account or the prepaid expense account. Now in the first bill, what happens is that the company adjusts out of 10,000, let's say the company adjusts 1,000 amount in the first bill itself. And in every bill, it will go on adjusting 1,000. So when that bill comes, MTNL is asking us to pay only 1,000 rupees because it has adjusted out of the 2,000 bill, it has adjusted 1,000 and only 1,000 has to be paid. So this 1,000 we debit to the profit and loss account, which is to be paid by us. And the 1,000 which has been adjusted, what we do is that we have debited the asset account or the prepaid expenses account. Now we credit that account and we debit the profit and loss account with the 1,000 rupees. So the profit and loss account is being debited now by 2,000 rupees actually. Out of that, 1,000 is the money that is being paid directly to MTNL, and 1,000 is the adjustment where a capital amount is being converted into a revenue expenditure. Now here illustration 6, Messrs. Ballav and Company of Delhi, the third example right before you right now. Messrs. Ballab and Company of Delhi, they purchased a machinery from Messrs. Shah and Company of Ahmedabad. Messrs. Ballab and Company, they spent 40,000 rupees for transportation of the machinery. So machinery is transported and then installed. Therefore, transportation cost of the machinery also adds up to the cost of the machinery. And therefore, that amount is capital expenditure in nature. Now that we have come to the end of this chapter, we'll do some questions. The first question is, the money which was spent, let's say 10,000 rupees, it was a traveling expenditure of the directors on the trips abroad for purchase of the capital assets. And as we have seen that this amount was spent on the directors' travel because directors went abroad to purchase the capital asset. Therefore, the traveling expense is relatable directly to the purchase of the capital asset, and therefore it is a capital expenditure. Now we come to the second question. An amount of 5,000 rupees was spent as lawyer's fee to defend a suit claiming that the firm's factory site belonged to the plaintiff's land. We have discussed it in the earlier discussion also. A suit is filed in which a claim is made that the firm's factory site was on the plaintiff's land. Plaintiff is the person who's making the plaint in the civil court by way of a suit. He says that is my land on which they have constructed the factory. And therefore the company, the factory firm has to fight the case, and they pay 5,000 rupees as lawyer's fee. So this lawyer's fee is being paid to maintain the business, because if this fee is not paid and they lose the business, the factory won't be able to operate. And therefore it is a revenue expenditure in nature, because this expenditure is being made to maintain the business, not to increase the productivity of the business or the time of the business. Now question number 3. Entrance fee of rupees 2,000 rupees is received by Ram and Sham Social Club. Ram and Sham Social Club is receiving the entrance fee. Entrance fee gives a long-term enduring benefit, and therefore it is a capital receipt in nature. Number 4, subsidy of 40,000 rupees is received from the government for working capital by a manufacturing concern. Please remember one thing: working capital is a capital which is used to work the business on a daily basis. It is an operational expenditure that is required by the business to operate. And if this capital is not there from the government, maybe the business is not able to operate, and that is why the government is giving subsidies so that business can be alive and operational. And therefore, if the subsidy is going towards working capital, it is not for a future benefit. It is not for the future enduring benefit. The subsidy is for the current benefit. So the test is not subsidy, test is what is the benefit, whether it is enduring benefit or not. And therefore, this particular subsidy, which is going towards working capital of a manufacturing concern, is the revenue receipt for the manufacturing concern. Now, the question number 5. Insurance claim which is received on account of machinery which is damaged completely by fire. Therefore, as we have already discussed, the capital receipt in nature, because it's directly relatable to increasing the value of the machinery. The machinery value was almost zero after the fire now. And therefore, the value is being increased. Now, question number 6 says the interest on investment which is received from UTI. What is that? So interest is a revenue receipt in nature because it is received in the ordinary course of the business. Therefore, it's a revenue receipt. The amount which is received from IDBI as a medium-term loan for augmenting the working capital. IDBI is an agency which gives loan. Now here, it's very interesting to see that working capital is being augmented not on the short-term basis, but on the medium-term basis. This medium-term means there is an enduring benefit which is coming here. Working capital is being augmented not just for 1 year, but for the medium term. And therefore, this amount which is being received from IDBI is a capital receipt in nature. Now we go to question number 8. The revenue from the sale of products ordinarily is reported as part of the earning in the period in which, what is happening here is products which are normally sold by a company or a firm which is doing a business. They are selling a product which they normally sell, and whatever revenue is being received from there, which it will be reported as part of the earning in the period in which the sale is made, because the revenue will be, according to the matching principle, reported in the same year or the same period when the sale is being made, because it is directly relatable to the sale of the products. Now, question number 9. If the repair cost is 25,000 rupees, whitewash expenses are 5,000 rupees, and both these expenses relate to presently used building, a building which is being used presently, on that a repair is being made for 25,000 rupees, whitewash expenses are also made 5,000 rupees, and a cost of extension of the building is also incurred of 2,50,000 rupees. And the cost of improvement in the electrical wiring system is also incurred of 19,000 rupees. Now we have to determine how much amount has to be expensed. When we say how much amount has to be expensed, which what we mean by that, what we mean is that how much amount has to be debited to the profit and loss account. How much amount will be taken as the expenditure of the current year. Obviously, when a building is in existence, the cost of extension of that building will lead to enduring benefit, and this 2,50,000 rupees is therefore a capital expenditure and not the revenue expenditure. And similarly, the cost of improvement in the electrical wiring system will also lead to enduring benefit over a number of years, and therefore even the 19,000 rupees is also a capital expenditure in nature, and therefore only the repair cost that is being incurred and the whitewash expenses, these two items are the only items which will be expensed in the current year, and therefore 25 plus 5 is 30,000. An amount of 30,000 will be expenditure of the current year. So that's how an analysis has to be made, whether an expenditure is capital expenditure or revenue expenditure, or whether receipt is a capital receipt or a revenue receipt. And this distinction has to be made very, very clearly if we are sure about what we are writing into the accounts is correct. But at the same time, making this distinction is a very tricky job at times, because the dividing line is very thin at times. We have to be careful, and we have to look at the broad principles that help us to determine whether an expenditure or a receipt is revenue or capital in nature. So friends, with that we come to the end of this topic, and in our next lecture tomorrow morning we will begin a fresh topic. And since we will begin a fresh topic, we are bringing this particular topic to a close and this webinar also to a close.